Welcome to the Pro Ticker Deep Dive. If you're looking at your screen today, the tape is, it's undoubtedly red.
Extremely red.
Yeah. We have a major escalating conflict in the Middle East, disrupted global supply chains, and technical charts that look like they have completely broken down.
Mm-hmm.
If you're just reading the front pages of the financial press right now, the overriding emotion being sold to you is just pure panic.
Pure panic, yeah.
But underneath that noise, if you look at the actual capital flows, some of the smartest, most heavily capitalized institutional money in the world is, well, they're quietly buying.
Right, they are.
They're looking at the exact same data, the exact same geopolitical tension, and they are projecting record market highs by the end of the year.
Which sounds crazy to most people.
It does. It sounds completely detached. So today, our goal is to figure out what they see that the rest of the market is just missing.
It's the defining tension of the market right now. You have the visceral, immediate fear generated by geopolitical instability colliding directly with the cold algorithmic models of institutional earnings forecasts.
Right.
For anyone trying to manage their own capital, it is an incredibly disorienting environment. You're essentially being told by the headlines that the system is fracturing, while the underlying corporate data suggests the engine is actually running quite well.
And that is exactly why today's deep dive is custom built for you. The mission today isn't just to recite the news. You can get that anywhere.
Yeah.
Our mission is to cut through that surface level panic and look at the actual plumbing of the financial system. We're going to synthesize the raw macroeconomic data, look at how the institutional algorithms are trading the technical levels.
For invisible lines.
Exactly. And dissect some structural policy shifts happening in Washington that are flying completely under the radar right now. We need to explore the second-order and third-order effects of these events so you can understand what this means for your portfolio, your asset allocation, and your broader strategy over the next decade.
Exactly. We need to move beyond just, acknowledging that a number went up or down. We need to explore the mechanics behind those moves. Knowledge in this environment is only valuable when you understand the why and the how.
Absolutely.
The global economy right now is an incredibly complex, interconnected mechanism. If a GUE shifts in the Middle East or a legal ruling comes down in Washington, it immediately alters the calculus for equity valuations, bond yields, commodity prices globally. Our job is to map out that transmission mechanism for you.
Okay, so let's start right at the epicenter of the immediate anxiety, the geopolitical catalyst in the Middle East. We're looking at unprecedented joint airstrikes across Iran. And this is not just a localized skirmish. This has resulted in the elimination of senior leadership and triggered a wave of systemic de-risking across global markets.
The scale is what initially caught the algorithmic models off guard. The market is generally very efficient at pricing in localized, predictable conflict. What it struggles to price in is sudden, sweeping escalation that threatens foundational infrastructure.
It hates uncertainty.
It despises it, and the immediate fallout was instantaneous. Within hours of the news breaking, we saw massive airspace disruptions across the entire Gulf region.
Yeah.
Major global aviation hubs, specifically Dubai and Doha, essentially had to suspend operations. Carriers halted flights immediately.
And just to pause on that for a second, when we talk about Dubai and Doha suspending operations, we aren't just talking about disrupted vacations, right? We're talking about global logistics, high-value air freight.
Precisely. A significant percentage of high-margin, time-sensitive global freight pharmaceuticals, advanced microchips, specialized manufacturing components that travels in the cargo holds of passenger jets or dedicated freighters routing through those exact hubs.
Wow.
When you shut down that airspace, you are instantly introducing friction into the supply chains of multinational corporations operating in Europe and Asia.
Right.
But as disruptive as the airspace issue is, it's secondary to the primary threat that the commodity traders instantly priced in.
The threat of retaliatory strikes targeting regional oil infrastructure.
Exactly. That's the big one.
Which brings us to the absolute jugular of the global economy, the Strait of Hormuz. We hear this name every time there's tension in the region, but let's break down the actual logistics of this waterway. Why is this specific narrow channel so uniquely critical that merely the threat of a disruption sends energy markets into a violent spiral?
To understand the Strait of Hormuz, you have to look at the sheer volume of energy that physically passes through it. It is the world's most vital energy choke point. We're talking about Roughly 21 million barrels of oil per day moving through a channel that, at its narrowest point, is only about 21 miles wide.
Wow,
And the shipping lanes themselves are only 2 miles wide in either direction.
that's incredibly tight.
It is. And that 21 million barrels represents more than 1/5 of total global oil demand and nearly 1/3 of all seaborne traded oil.
21 million barrels a day. I mean, the scale is just staggering.
It's the lifeblood of the industrial economies in Asia and Europe. Now, the critical nuance here is that you don't actually need a physical military blockade to disrupt this flow.
Really?
No. The financial markets can effectively shut down the strait on their own through the insurance mechanism.
Okay, let's look under the hood of that. How does an insurance market shut down a physical waterway?
Every commercial supertanker moving through that region requires highly specialized maritime insurance, specifically war risk premiums, often underwritten by syndicates at Lloyd's of London. When the perceived risk of a missile strike or a vessel seizure spikes, those war risk premiums skyrocket. If the premiums become prohibitively expensive, or if the underwriters outright refuse to cover vessels entering the Persian Gulf, the major shipping conglomerates will simply refuse to sail.
Because they won't risk the asset.
Exactly. They will not risk a $100 million asset and its cargo without coverage. So, without a single ship physically blocking the channel, the financial friction alone can cause a synchronized global supply shock.
That is a fascinating dynamic. It's the paper market dictating the physical market.
Yep.
And the reaction in the physical market was incredibly violent. We saw West Texas intermediate crude surge nearly 9.4% almost instantly, hitting roughly $99.50 a barrel.
Right to the edge of 100.
Yeah, and global benchmarks effortlessly shattered that psychological $100 mark.
Yeah.
And I'm seeing institutional projections suggesting that if the strait remains depressed or restricted for any meaningful duration, we could easily be looking at $130 a barrel.
Which changes everything.
So break down the math on that for me. How does a spike to $130 a barrel actually ripple through the broader economy? Because it's much more than just a number flashing on a commodities terminal.
It translates directly and aggressively into the cost of living and the cost of corporate operations. Let's look at the historical transmission mechanism. Generally speaking, a 10% rise in the price of crude oil eventually increases headline consumer inflation by about 0.2 to 0.3 percentage points.
Okay.
But that's just the initial wave. Inflation is insidious because it compounds. When oil jumps from $80 to $100 or pushes toward $130, you are increasing the fundamental input cost of modern civilization.
Right, because it's not just gasoline for cars. It's diesel for the trucking fleets, jet fuel for the cargo planes.
Petroleum feedstocks for plastics, fertilizers, pharmaceuticals.
Everything.
Everything. Every single physical product that needs to be extracted, manufactured, packaged, and transported suddenly costs more to produce. Now, it's crucial to note that the United States is somewhat uniquely positioned here compared to historical oil shocks.
Because of domestic production.
Exactly. The U.S. is now a massive domestic producer of energy, primarily due to the shale revolution. So the domestic economy has a partial buffer. But Europe and Asia, they are heavily structurally exposed.
They're net importers.
They are. When global crude spikes, their industrial base takes a direct hit to profitability. And because U.S. multinational corporations generate a massive portion of their revenue overseas, a slowdown in Europe or Asia inevitably drags down U.S. corporate earnings.
Okay, let me push back on that slightly, or at least play devil's advocate here. If the U.S. is producing so much of its own energy, shouldn't a higher oil price actually be a net benefit for the massive domestic energy sector? Doesn't the capital just shift from consumer discretionary spending into energy capital expenditures?
In a vacuum, yes. The domestic energy sector becomes incredibly profitable, and we are seeing that in their cash flow yields right now. However, the broader economic damage usually outweighs the localized sector benefit.
Makes sense.
For the average consumer, a spike in energy prices acts exactly like a highly regressive, unavoidable tax. When you have to spend an extra $50 or $100 a month just to commute to work and heat your home, that is liquidity directly drained from the broader economy.
Right.
That's money you're not spending on streaming subscriptions, dining out, buying new electronics. Discretionary spending gets aggressively squeezed.
Which naturally brings us to the ultimate nightmare scenario for the Federal Reserve, stagflation.
Yes. Stagflation is the toxic paralytic combination of stagnant economic growth and rising persistent inflation. And an energy shock is the textbook catalyst for it.
Yeah?
The high oil prices act as a massive drag on economic growth, causing the stagnation, while simultaneously driving up the cost of goods across the board, causing the inflation.
And it completely traps the central bank, doesn't it? Because their tools are suddenly working against each other.
Exactly. Central banks traditionally fight inflation by raising interest rates to cool down demand and slow the economy. But if the economy is already slowing down because high energy prices are crushing consumer spending, raising interest rates just deepens the pain and pushes you faster into a recession.
You're boxed in.
You are. It essentially boxes policymakers into a corner where they have to choose between letting inflation run hot or deliberately causing a severe economic contraction.
That is a terrifying macro environment for a portfolio manager to navigate.
Yeah.
And that specific fear, the anticipation of a central bank policy error in the face of stagflation, is exactly what we saw play out in the equity markets. Let's look at the technical damage, because it was swift and severe.
Very swift.
The S&P 500 closed at roughly 6,740. That's the lowest level since mid-December.
Yeah.
And the way it fell is what really triggered the alarm bells across the trading desks.
Oh, absolutely.
It sliced right through its 50-day moving average, which was sitting around 6,838, and its 100-day moving average at 6,835. And it did this on heavy institutional volume.
Heavy volume. That's the key.
Now, I know a lot of our listeners are highly financially literate, but for those who might not spend their day staring at candlestick charts, let's briefly touch on why algorithmic traders care so deeply about these specific invisible lines.
We don't need to get bogged down in the basic definitions, but it's important to understand the mechanics of how institutional money uses these levels. Think of moving averages like the 50-day or the 100-day as the market's collective mathematical memory of recent pricing trends.
Okay.
The reason they matter so intensely is that the modern stock market is heavily dominated by algorithmic and quantitative trading strategies. These systems are programmed to use these specific moving averages as rigid binary triggers.
So it's not a human making a discretionary choice to sell. It's a machine executing code when a condition is met.
Precisely. In a healthy, upward trending market, these moving averages act as a floor or support. Algorithmic strategies are programmed to buy the dip when the price touches that line. But when a geopolitical shock causes the market to gap down and crash through those averages, especially on high volume, which indicates heavy, aggressive selling rather than just a lack of buyers, the algorithms instantly flip. The programming switches from buy the dip to liquidate risk. That line goes from being a floor to being a ceiling.
And the fact that the S&P broke both the 50-day and the 100-day almost simultaneously tells you that the downward momentum is incredibly forceful.
Yeah.
Which leads us to a term that the financial media loves to sensationalize, the death cross.
Oh, they love that term.
They really do. We saw the 20-day moving average cross below the 50-day. That sounds dramatic. But how significant is it really in the context of modern market structure?
It's a highly recognized momentum signal, specifically for trend-following quants and commodity trading advisors, or CTAs. A death cross simply illustrates that the immediate short-term momentum, the 20-day average, is now deteriorating faster than the medium-term trend, the 50-day. When these specific quantitative funds see that mathematical crossover, their mandates often require them to systematically reduce their equity exposure and short the market.
So it creates a negative feedback loop. The initial geopolitical fear causes selling. The selling breaks the technical levels. The broken levels trigger the death cross. And the death cross forces the algorithms to aggressively short the market, which creates even more selling.
That's the cascade.
Where is the circuit breaker in that loop? What is the final line of structural defense for the index right now?
The line that every institutional desk is staring at right now is the 200-day moving average, currently sitting around 6,582.
6,582.
Yes. The 200-day is universally considered the demarcation line between a secular bull market and a structural bear market. Historically, during periods of acute geopolitical stress or sudden energy spikes, if the market loses the 100-day average, there is a very high mathematical probability that it will mean revert all the way down to test the 200-day.
It's a magnet.
It acts as the ultimate bedrock. If the 200-day breaks on heavy volume, then the narrative shifts entirely. You are no longer talking about a mid-cycle correction. You're having a conversation about capital preservation in a bear market.
And you can see the fast money aggressively positioning for that exact scenario. The VIX, the volatility index, often called the fear gauge, surged 24% to near 30.
Massive move.
Furthermore, prime brokerage data shows that hedge funds increased their short positions in equity ETFs by 8.3% in a single week. That's the second fastest rate of bearish downward betting we've seen in half a decade. The hedge funds are smelling blood in the water.
That is the definitive bear case playing out in real time. The technical structure is broken, volatility is expanding, and leveraged funds are actively shorting the index.
Right.
But this is exactly why looking at multiple perspectives is paramount for you as an investor. Because while the tactical short-term hedge funds are aggressively selling the panic, the strategic long-term institutional money is doing something completely counterintuitive.
All right, this is the profound disconnect I mentioned at the top of the deep dive. Despite the broken charts, despite the death cross, despite the volatility spike, major institutional research desks are maintaining, and in some cases defending, their targets for the S&P 500 to hit 7,250, 7,500, and even 8,000 by the end of 2026. If the market is currently tumbling through 6,740, forecasting 8,000 seems wildly detached from reality. What is the fundamental architecture supporting that profound optimism?
The architecture is built on the reality that long-term market performance is rarely dictated by the immediate emotional response to geopolitical shocks. Ultimately, over a multi-year horizon, stock prices follow one fundamental metric: corporate earnings. And right now, beneath the terrifying headlines, the earnings data is exceptionally robust. Analysts are projecting that earnings per share for the S&P 500 will increase by roughly 12% this year.
12%.
That is powerful, double-digit growth. The institutions forecasting 8,000 are looking at resilient domestic labor data, massive ongoing fiscal stimulus, and corporations that have spent the last 3 years ruthlessly optimizing their operations to defend their profit margins.
They trim the fat.
Exactly. They do not view this current geopolitical sell-off as the end of the expansion. They view it as a severe but temporary mid-cycle correction that's creating a mispricing opportunity.
Let's ground that in some historical context, because this time is different. Are the four most dangerous words in investing? Have we seen this specific setup before? A massive geopolitical shock causing a technical breakdown, only to be overwhelmed by corporate earnings.
We have seen it repeatedly. The historical precedent is very clear. Geopolitical shocks rarely derail a secular bull market permanently unless they trigger a severe, deeply entrenched global economic recession.
Okay.
Let's look at the start of the Russia-Ukraine conflict in early 2022, or going further back to a more accurate parallel, the Yom Kippur War and the subsequent Arab oil embargo in 1973.
Right, the oil shocks.
In both instances, markets initially plunged violently as risk premiums were rapidly reassessed. Panic was the dominant emotion. But historically, liquidating your portfolio into the initial shock wave of a geopolitical event is a statistically losing strategy.
Because the market is a forward-looking discounting mechanism. It prices in the absolute worst-case scenario immediately and then slowly recovers as reality turns out to be slightly less apocalyptic.
Precisely.
Yeah.
The market is highly adaptive. Supply chains eventually reroute. We see the emergence of shadow fleets in the oil market. Alternative transit corridors are established. Corporations adjust their pricing models.
Things find a way.
Eventually, the focus returns to cash flow. The institutional analysts defending that 8,000 target are betting heavily that this current crisis, while severe, will not fundamentally break the earning power of the American consumer or the structural profitability of major U.S. corporations.
So if the geopolitical shock eventually washes out, what about these structural shocks at home? Because while everyone is watching the airspace over the Gulf, there are some massive foundational policy shifts happening in Washington that are going to dictate market returns just as heavily. Let's talk domestic policy.
Yeah, we need to.
And just to front-load this for everyone listening, we were looking at this strictly through the lens of capital, mathematics, and market mechanics. We are discussing highly charged political developments, actions taken by the administration, and Supreme Court rulings.
Right.
Regardless of your personal political ideology, our goal here is absolute impartiality. We are not endorsing these policies or criticizing the politicians making them. We are simply taking the facts, analyzing the legal and economic mechanisms, and figuring out how they are going to reprice assets in your portfolio.
It is absolutely vital to separate your political ideology from your investment strategy. The market doesn't care about our political preferences. It only cares about mathematical consequences. And the policy landscape right now is delivering some profound mathematical shocks.
Let's start with a ruling that feels like an economic earthquake but hasn't received nearly enough attention. The Supreme Court just ruled, in a 6-3 decision, that certain emergency tariffs levied by the administration under the International Emergency Economic Powers Act, or IEEPA, are unconstitutional and illegal.
Massive.
This is a staggering reversal of executive trade policy.
It's a landmark legal decision, but its economic implications are what we really need to focus on. For context, IEEPA has been utilized in recent years to enact sweeping unilateral tariffs quickly, bypassing traditional legislative processes by citing national economic emergencies.
Right.
The Supreme Court has now fundamentally reined in that specific application of executive authority, but the immediate tangible windfall of this ruling is what the markets are quietly digesting.
The refunds.
Yes. The U.S. government could essentially be forced to refund between $130 billion and $175 billion in collected tariff revenue directly back to the importers who initially paid it.
Let's follow the money on that, because $175 billion is an immense amount of capital. That is roughly 0.5% of the entire United States gross domestic product just suddenly being handed back to the private sector. How does that money actually flow through the system? Does it just sit on corporate balance sheets, or does it act as an active stimulus?
It acts as a massive, highly targeted, and completely unexpected fiscal stimulus. Let's look at the mechanics of a tariff. When a major domestic retailer imports goods, they are the ones who actually write the check to the government for the tariff.
Okay.
To protect their operating margins, they almost always pass that additional cost directly onto you, the consumer, by raising the final retail price. Now, imagine a mid-cap retail corporation suddenly receiving a retroactive refund check for hundreds of millions of dollars from the Treasury. That is an immediate, unforecasted injection of pure earnings.
So what do they do with it? Do they just use it for stock buybacks?
They have a few options, and all of them are generally bullish for equities. They can return it directly to shareholders via special dividends or aggressive share buyback programs, which artificially boosts their earnings per share.
Sure.
They can reinvest it into their logistics and supply chain infrastructure, or, and this is the most critical point for the macroeconomy, they can use that capital buffer to lower their retail prices to aggressively undercut their competitors and gain market share.
Wait, if they use it to lower prices, that fundamentally alters the inflation narrative we were just talking about with the oil shock.
Exactly. You're hitting on the crucial dynamic here. We just established that $100 oil is an inflationary drag that threatens stagflation. But removing $175 billion in tariff burdens does the exact opposite.
It's disinflationary.
It exerts powerful structural downward pressure on the prices of imported goods. It effectively lowers the tax rate on the movement of physical goods. For the broader market, this massive tariff refund acts as a powerful, disinflationary counterbalance to the energy shock. It's a highly bullish signal for consumer spending resilience and corporate profit margins.
It's like the economy's being handed a massive stimulus check just as the energy tax hits. And the trade environment seems to be cooling down on another major front as well. We just saw a high-level meeting between the U.S. and China that resulted in a very surprising de-escalation of immediate tensions.
Very surprising.
We saw agreements to reduce fentanyl-linked tariffs, China resuming meaningful purchases of U.S. soybeans, and perhaps most importantly for the tech sector, a pause on Chinese export controls for rare earth minerals.
This is a significant relief valve for global markets. Over the past several years, the bilateral relationship between the world's two largest economies has been defined by friction, tariff threats, and tit-for-tat export controls.
Constant escalation.
Exactly. This recent meeting suggests a pragmatic, tactical pause in that economic hostility. But for the listener managing a portfolio, the absolute most critical takeaway from that meeting is the pause on rare earth export controls.
Break down why rare earths are so vital. Because we hear the term, but the actual reliance is often misunderstood.
Rare earth minerals are the fundamental, irreplaceable building blocks of the modern digital and green economy. They are essential for manufacturing the advanced permanent magnets used in everything from the latest smartphones and electric vehicle motors to advanced military guidance systems and F-35 fighter jets.
Wow.
And currently, China completely dominates the global processing and refining capacity for these minerals. By agreeing to pause export controls, they are dramatically reducing the immediate supply chain anxiety for massive sectors of the U.S. economy.
The tech sector especially.
Specifically, the high-beta technology sector, defense manufacturing, and the entire EV ecosystem. When a multinational tech giant knows its critical material supply chain is secure for the next few quarters, they can plan capital expenditures and execute growth strategies with much higher confidence. It removes a massive risk premium from their valuation.
Okay, so we have an unexpected domestic stimulus from the Supreme Court and a tactical de-escalation with China securing tech supply chains. But Washington is incredibly active right now, and not all the wild cards are universally bullish. The administration just floated a new proposal to federally cap credit card interest rates at an absolute maximum of 10% for a period of 1 year.
This is a complex one.
It is. Now, if you are a consumer currently carrying revolving credit card debt at 24% or 28%, a mandated drop to 10% sounds like a miracle. It sounds like massive consumer relief. But I have a hard time believing the major financial institutions are just going to accept a catastrophic hit to their net interest margins without reacting. How do the actual mechanics of a cap like this play out in the real economy?
Your skepticism is entirely warranted. It's a perfect case study in how market policies, however well-intentioned, often generate immediate structural unintended consequences.
Right.
On the surface, a 10% interest rate cap looks like a massive populist win for the struggling consumer and a devastating direct blow to bank revenues. And indeed, the initial algorithmic reaction to the headline would likely be a sharp sell-off in major financial stocks and credit card issuers as models immediately reprice the loss of projected interest income.
But the banks fight back.
Major money center banks are incredibly sophisticated and ruthless at protecting their risk-adjusted margins. If the government forcefully caps the price of credit at 10%, the banks will simply alter the availability of that credit and extract the revenue through alternative channels.
So it's essentially like squeezing a balloon. You squeeze down the interest rate side and the pressure just forces another part of the balloon to expand. What does that expansion look like for the average person trying to use a credit card?
It looks like a severe, immediate contraction in credit availability, specifically for the people the policy is intended to help. Think about the risk models.
Right.
If a bank is legally prohibited from charging more than 10%, they are absolutely not going to extend unsecured revolving credit to a consumer with a subprime credit score. The mathematical risk of default far outweighs the capped 10% potential return, so credit will become entirely inaccessible for lower income brackets.
I mean, just get cut off.
Cut off completely. Furthermore, to make up the lost margin on prime borrowers, banks will aggressively introduce or hike annual fees on every card. They will increase late payment penalties, eliminate cashback and travel rewards programs, and broadly slash existing credit limits to reduce their overall balance sheet exposure.
Let me play devil's advocate here, though. If we look at the macroeconomic picture, consumer debt levels are at historic highs. Delinquencies in auto loans and credit cards are creeping up. Isn't intentionally cutting off subprime lending and forcing banks to de-risk their balance sheets actually a positive development?
Yeah.
Couldn't this prevent a massive consumer debt bubble from popping down the line, ultimately making the financial system healthier?
From a macroprudential, long-term systemic risk perspective, you can absolutely make that argument. Deleveraging the subprime consumer does remove a layer of fragility from the financial system. It forces banks to hold higher quality, lower risk assets.
Right.
And because these major financial institutions possess such immense pricing power and diverse revenue streams from wealth management to investment banking, they can weather the initial shock. They'll take a brief hit to their equity valuation on the headline, but ultimately they have the systemic mechanisms to navigate the rule, tighten their lending standards, and maintain overall profitability.
But the consumer feels the pain.
The pain will largely be localized to the consumer who suddenly finds their credit line closed.
It's a brilliant example of why you cannot trade the initial headline. You have to trade the secondary reaction.
Always.
Now, I want to transition to perhaps the most staggering, unprecedented wild card we have seen in modern financial history. The Department of Justice has officially launched a criminal investigation into the chair of the Federal Reserve regarding statements made during congressional testimony.
Yeah.
I am honestly struggling to find a historical analog for this. We're used to politicians complaining about interest rates, but a DOJ criminal probe into the sitting Fed chair. This strikes at the very foundation of the system.
It is a genuinely monumental development. You're right to struggle finding an analog because there isn't a direct one in modern U.S. history.
It's completely new territory.
It is. The absolute cornerstone of the Federal Reserve's power, and the reason global bond markets trust U.S. monetary policy, is its perceived independence from the partisan political apparatus. Global capital trusts the Fed because the underlying assumption is that decisions regarding interest rates, quantitative tightening, and systemic liquidity are dictated by cold, hard economic data, specifically inflation and employment metrics, and not by the electoral desires of whoever occupies the executive branch.
Right. The Fed is supposed to be untouchable.
A Department of Justice criminal investigation into the chair strikes a direct structural blow to the heart of that perceived independence.
And if there is one thing that global capital markets despise above all else, it's uncertainty regarding the rules of the game. If the referee is suddenly under investigation, the players panic. So what are the immediate mechanical impacts of this for the investor? Because for the last year, the only thing the market has obsessed over is the exact timing of the Fed's next interest rate cut.
The immediate mechanical impact is a violent repricing of yield curves and rate expectations. The market-implied probability of any imminent interest rate cut drops significantly.
They price it out entirely.
Pretty much. The logic driving the bond market is that the Federal Open Market Committee, the FOMC, will be practically paralyzed. They will likely hesitate to make any major market-moving policy shifts while operating under the shadow of a federal investigation, simply to avoid any appearance of political capitulation or impropriety. They'll freeze policy to project institutional stability.
So the higher for longer rate environment just gets extended indefinitely. But surely if the economic data starts deteriorating, if unemployment spikes, they have to cut rates.
Right. That's where we encounter a deeply concerning psychological dynamic. There is a growing structural fear among institutional money managers that if the Fed does cut rates in this highly politicized environment, it could trigger a massive sell the news event.
Because it breaks the usual pattern.
Right. Let's look at standard market psychology. Normally, an interest rate cut is the ultimate green light for the equity market. It lowers corporate borrowing costs, expands valuation multiples, stimulates consumer demand. It's inherently bullish.
Everybody loves a rate cut.
But right now, consider the context. We have inflation potentially warming back up due to the $100 oil shock. If the Fed chooses to cut interest rates into an inflationary energy shock while the chair is under criminal investigation, investors might interpret that action completely differently.
They won't see it as a victory over inflation. They'll see it as a loss of institutional control.
Precisely. They might view the rate cut as a signal that the underlying economy is actually much weaker, much more fragile than the public data suggests, forcing a panic cut. Or even more damaging to systemic trust. They might view it as the Fed fundamentally succumbing to political pressure to stimulate the economy ahead of an election cycle.
Which destroys their credibility.
Completely. In either of those scenarios, an interest rate cut does not trigger a stock market rally. It triggers a violent defensive sell-off as institutional capital loses faith in the currency and flees to safety.
A rate cut becoming a deeply bearish, panic-inducing signal. That truly illustrates how distorted and fragile the macro landscape has become.
It's upside down.
Okay, let's take a breath and synthesize where we are. We've navigated the geopolitical explosions in the Middle East, the terrifying reality of stagflation, technical charts breaking key moving averages, $175 billion tariff stimulus, credit card crackdowns, and a Federal Reserve essentially paralyzed by a DOJ investigation. That is a violently turbulent ocean of data.
It's a lot to process.
It is. So if the referee is under investigation and the game is chaotic, how does a retail investor actually protect their money right now? Where are the safe havens and where should we be hunting for opportunity? Let's move to portfolio positioning.
Let's do it.
When systemic trust fractures, capital usually flows to the oldest asset on Earth. Let's talk about gold. It has absolutely surged. We are seeing it trade in a massive elevated range between $5,000 and $5,277 an ounce. Why does gold continue to be the undisputed king of the panic trade?
Gold is behaving exactly as its historical 5,000-year profile dictates it should. When you have a confluence of extreme geopolitical fear and deep structural concerns regarding the credibility of fiat currencies, which is exactly what a DOJ investigation into the central bank triggers institutional capital, reflexively flees to real, tangible assets.
It makes sense.
We need to understand the concept of counterparty risk. It's a term thrown around constantly, but it is the key to gold's value.
Just to ground that for a second for the listener, counterparty risk simply means the risk that the entity on the other side of your financial agreement goes bankrupt or reneges before they can pay you. If you own a corporate bond, the corporation is your counterparty. If they fail, your bond is worthless.
Exactly.
Yeah.
Even fiat currency, like the US dollar, relies on the full faith and credit of the government. That is the counterparty. Gold is the ultimate strategic macroeconomic hedge precisely because it possesses zero counterparty risk.
Because it's just a rock.
A very valuable rock. But yes, it exists entirely outside the traditional interconnected digital financial system. A sovereign nation defaulting on its debt, a major regional banking crisis, a frozen digital stock exchange, or a paralyzed central bank, none of these events fundamentally alter the physical properties or the intrinsic value of an ounce of gold.
Right.
When trust in the complex web of financial promises fractures, institutional money parks its wealth in gold to preserve base purchasing power. It is an insurance policy against systemic failure.
Which naturally leads us to the multi-trillion-dollar question regarding the modern challenger to gold. What about crypto? Specifically Bitcoin. For the last decade, the loudest narrative in the crypto space was that Bitcoin was digital gold, the ultimate uncorrelated safe haven asset for the digital age.
The digital gold narrative. Yeah.
But as physical gold rockets past $5,000, Bitcoin has retreated, struggling near the $65,000 mark. Is this the definitive moment the digital gold narrative falls apart?
It's undeniably a critical real-world stress test of that specific thesis, and the divergence in price action is highly revealing. While physical gold surged aggressively on the initial news of the Middle East airstrikes and the Fed investigation, Bitcoin experienced a sharp pullback.
They moved in opposite directions.
They did. This empirical data suggests that, at least in the current market microstructure, the broader institutional capital base is treating digital assets not as a safe haven store of value, but as highly correlated, high beta risk assets.
So it trades more like a speculative software company than a precious metal?
Yes. When quantitative models and risk managers decide to de-risk their portfolios due to a geopolitical shock, they systematically sell off their most volatile assets first. They sell unprofitable tech stocks, they sell high-yield junk bonds, and they sell Bitcoin.
It's lumped in with the risk.
It's moving in lockstep with the NASDAQ, not with gold. Now, this doesn't invalidate the long-term technological adoption or the utility of digital assets. But this specific crisis clearly highlights that in a moment of true acute panic, when liquidity is paramount, global capital still overwhelmingly prefers the proven millennia-old track record of physical gold over the 15-year track record of digital algorithmic scarcity.
That is a harsh mathematical reality check for the crypto bulls. Okay, so gold is the ultimate bunker to hide in. But what if an investor wants to go on the offensive? What if they want to hunt? What are the immediate tactical, sector-specific moves being heavily favored by institutional desks in a world defined by $100 oil and broken supply chains?
The tactical institutional playbook right now is entirely focused on companies that possess pricing power and benefit directly from the specific catalysts causing the chaos. The strategy is highly concentrated.
Where are they looking?
The first clear winner is the energy sector. We are talking about the massive integrated energy majors companies involved in the extraction, refining, and global distribution of oil and natural gas.
Because they directly profit from the shock.
When crude sits at $100 or $130 a barrel, these companies aren't just surviving. They are printing unprecedented levels of free cash flow. They are the direct mechanical beneficiaries of the geopolitical supply shock.
And the second sector.
The second major overweight is the defense and aerospace sector. Whenever there is a sudden, violent escalation in global conflict, every sovereign government instantly reassesses its military readiness and ammunition stockpiles.
So the budgets expand.
We see immediate structural increases in defense budgets globally. Major defense contractors are no longer viewed as cyclical plays. They're viewed as structural, multi-year growth stories operating in an era of heightened global friction.
It's a grim reality, but it makes perfect logical sense. By the companies that produce the specific resources the world is suddenly desperate to secure. But what about the other side of the ledger? Where should investors be incredibly cautious?
You must exercise extreme caution with high beta stocks. Those are equities that are mathematically highly volatile and tend to amplify the movements of the broader market. More specifically, you need to avoid certain highly leveraged segments of the technology sector.
Why tech specifically?
Many of these tech companies operate on models that require constant access to cheap borrowing costs to fund their operations and customer acquisition. Furthermore, they trade at massive valuation multiples because investors are pricing in explosive earnings growth projected 5 or 10 years into the future.
And if inflation stays hot because of the energy shock and the Fed is paralyzed, what happens to those future earnings?
They get mathematically crushed by the bond market. Which brings us to arguably the most important metric in global finance right now.
The 10-year Treasury yield.
Yes.
We spend so much time talking about the S&P 500, but The bond market is truly the tail that wags the dog. It dictates everything. You mentioned a crucial threshold for the 10-year yield. Explain that specific line in the sand and the mechanics behind it.
The 10-year U.S. Treasury yield is the foundational benchmark interest rate for the entire global economy. Every financial instrument on Earth, from a 30-year residential mortgage rate to the borrowing cost of a multinational corporation, is priced at a premium above that 10-year yield.
This is the baseline.
Right now, the absolute critical threshold that every trading desk is monitoring is 4.25%. If a 10-year yield pushes persistently above 4.25% and holds that level, the structural damage to the equity market, particularly the tech sector, will deepen considerably.
Break down the why for the listener. Why is 4.25% the magic number that breaks the stock market?
It comes down to a concept called the equity risk premium. The yield on a U.S. Treasury bond is universally considered the risk-free rate of return because it's backed by the U.S. government's ability to tax and print money. If you buy a Treasury, you are guaranteed that specific yield.
Right.
Equities, on the other hand, carry massive fundamental risk. Companies can miss earnings, face lawsuits, or go bankrupt. Therefore, investors demand a premium return to justify taking on that extra risk.
Makes total sense.
If the risk-free rate is sitting at 0% or 1%, investors are forced to buy risky tech stocks to generate any return on their capital. But if the risk-free 10-year yield rises to 4.3%, 4.5%, or higher, the math fundamentally changes.
You can just buy the bond.
If an institution can guarantee a 4.5% return from the U.S. government with zero volatility, the incentive to take on the massive risk of buying a volatile software company trading at 40 times earnings completely vanishes.
The risk-free rate simply becomes a black hole, sucking massive amounts of liquidity right out of the stock market.
Exactly. It causes a violent valuation reset. If that yield breaks 4.25% and holds, the S&P 500 will struggle immensely to find a floor, regardless of how strong the corporate earnings might be, simply because the alternative investment bonds is too attractive to ignore.
That is a phenomenal, actionable metric for the listener. Write that down, pin it to your monitor, watch the 10-year yield at 4.25%. Okay, we have navigated the immediate crisis, the political wildcards, and the tactical day-to-day portfolio mechanics. Now, for our final segment, I want to ask you to pull back.
Zoom out.
Exactly. Let's detach completely from the hourly ticks to the VIX.
Yeah.
Ignore the daily headlines and look at the distant horizon.
Yeah.
What are the 2026 megatrends? What is the foundational architecture of the next decade of capital markets? Because it feels like the fundamental rules of the game are changing.
They're not just changing. The old rule book is being actively burned. For the last 30 years, the prevailing, unquestioned theme of the global economy was globalization. It was an era characterized by hyper-optimized, frictionless, disinflationary trade.
Everybody trading with everybody.
Multinational corporations sourced raw materials from whichever country was cheapest, they assembled the products wherever labor was cheapest, and they shipped them globally using highly efficient, just-in-time logistics networks.
And that era is over.
That era is definitively over. The new overarching theme, the megatrend that will dictate capital flows for the next decade, is fragmentation.
Fragmentation. That's a heavy word. What does that actually look like in practice for a massive multinational corporation trying to build a product?
It requires a complete systemic reprioritization of corporate strategy. For 3 decades, the boardroom mantra was optimize for cost efficiency. Now, the mandate is optimize for supply chain resilience and national security.
So efficiency is out, survival is in.
Corporate boards are looking at the airspace shutdowns in the Middle East, they're looking at the tariff wars and export controls, and they're arriving at a stark realization.
Let me guess. Saving a few pennies on manufacturing isn't worth it if you can't actually get the product to the consumer.
Exactly. I was reading a case study recently about a major U.S. automaker. During the initial supply chain shocks a few years ago, they had thousands of 99% finished trucks sitting in massive holding lots for 6 months. They couldn't sell them.
Why?
Because they were waiting on a single 50-cent specialized microchip manufactured in Taiwan. That single point of failure cost them hundreds of millions in delayed revenue.
That's brutal.
That was the exact moment corporate America realized that optimizing for the absolute lowest cost was a lethally dangerous game in a fragmented world. We're now seeing a massive multi-trillion-dollar trend of reshoring and friendshoring.
Bringing manufacturing infrastructure back to the United States or relocating it to geopolitically allied nations like Mexico.
Precisely.
But building new factories in the U.S. with higher labor costs has to be inherently inflationary.
Right.
It is less efficient than the old model.
It is deeply inflationary. You are essentially trading cost efficiency for security. The products will cost more to make. However, this trend is also triggering a massive, historic boom in domestic industrial investment, advanced robotics, automation, and infrastructure development. The companies building the automated factories of the future are massive beneficiaries of this fragmentation.
And speaking of massive structural investments, we cannot talk about the next decade without addressing the absolute behemoth in the room, the artificial intelligence revolution.
Oh, absolutely.
The sheer scale of capital expenditures going into AI right now, the hundreds of billions being spent by tech giants on hyperscale data centers, dedicated power grids, and specialized semiconductor chips, is just mind-boggling. But we have to ask the difficult question. Is this a bubble? Because you hear comparisons to the dot-com crash of 2000 all the time.
The historical comparisons to previous technological bubbles are entirely valid, but they require critical nuance to understand. We absolutely must warn against blind, euphoric exuberance. Whenever you have a paradigm-shifting technology, history shows us a clear pattern.
Boom and bust.
Look at the railroad mania of the 1860s, or the massive debt-fueled build-out of fiber-optic cable networks in the late 1990s. In both instances, there was a period of wild, speculative overinvestment, followed by a spectacular, brutal market crash.
Because the infrastructure was built out way ahead of the actual consumer demand.
Yeah, precisely. They laid millions of miles of fiber optic cable before dial-up internet users even knew what to do with broadband speeds. However, and this is the crucial point for the long-term investor, in both of those historical examples, the underlying technology was genuinely transformative.
Right.
The railroads did fundamentally change the physical economy of the world. The dark fiber optic cables did lay the permanent groundwork for the modern high-speed internet and the cloud computing boom of the 2010s.
AI is on that exact same historical trajectory. The underlying technology is genuinely revolutionary. The computational power being deployed will change human productivity.
Exactly. So the inevitable crash doesn't mean the technology was a failure or a hoax. It just means the Wall Street valuations got completely detached from the near-term reality.
So how does a listener actually invest in the AI megatrend without getting annihilated in the inevitable washout of the hype cycle?
The key for the listener is ruthless differentiation. You have to separate the companies that are actually utilizing AI to generate real, measurable cash flow from the companies that are simply slapping the acronym AI onto their press releases to artificially inflate their stock price.
You want to see the AI actually showing up on the balance sheet.
Exactly. The first phase of this AI revolution heavily rewarded the pick-and-shovel providers, the semiconductor designers making the specialized chips, and the hardware companies building the physical data centers. That was the infrastructure phase.
What's the next phase?
The next phase, the phase that will dictate returns through 2026 and beyond, will heavily reward the enterprise application companies. You need to look for non-tech corporations, healthcare logistics companies, financial service firms, industrial manufacturers that are successfully integrating AI to drastically reduce their operating expenses or create entirely new, highly profitable revenue streams.
Real cash flow versus narrative hype.
You are looking for margin expansion driven by AI efficiency, not just vague promises of future disruption.
And finding those specific, high-quality companies leads us perfectly to the final megatrend, the absolute return of active management.
This is a huge shift.
For the last 10 to 15 years, the absolute best, most profitable, and easiest advice you could give anyone was to simply buy a passive, broad market S&P 500 index fund, reinvest the dividends, go to sleep, and wake up richer. It was a golden era for passive investing. Why is that specific, beloved strategy suddenly facing a structural threat?
That passive buy-the-index strategy worked flawlessly because it existed in a highly specific macroeconomic regime. It thrived in an environment characterized by 0% interest rates, virtually non-existent inflation, and peaceful, frictionless globalization. In that specific regime, capital was free, and a rising tide truly lifted all boats. Even mediocre companies survived because debt was virtually free to service.
But as we've discussed today, that regime is dead.
In this new environment, characterized by a 4.25% risk-free rate, rising geopolitical fragmentation, persistent inflation, and massive structural divergences between sectors, simply buying the whole market means you are buying a massive amount of dead weight.
You are indiscriminately buying the highly leveraged, failing companies right alongside the cash-flowing winners.
Exactly. When the energy sector and defense contractors are surging, but highly leveraged consumer discretionary companies and unprofitable tech firms are collapsing under the crushing weight of high bond yields, the overall index might just trade sideways for years or experience severe drawdowns.
Because the losers drag down the winners.
Furthermore, we have to acknowledge the massive concentration risk in the passive indexes right now. The S&P 500 is historically top-heavy, with the top 5 or 6 tech megacaps dictating the vast majority of the index's movement. If those specific 5 companies stumble due to an AI valuation reset or antitrust regulation, the entire passive index suffers immensely.
To generate actual real wealth in the next decade, active management and highly rigorous fundamental stock picking are making a major comeback.
You need portfolio managers, or you need to develop the personal analytical discipline to actively seek out companies with resilient, friend-shored supply chains, the pricing power to survive stagflation, and real, measurable AI monetization. You can no longer rely on the sheer momentum of central bank liquidity to do the heavy lifting for you.
Okay, let's bring all of these complex threads together. We have covered an immense, deep amount of ground today. To synthesize and wrap up, what we are witnessing in the markets right now is a period of incredible, violent tension. We have a direct clash between terrifying, real-world geopolitical headlines in the Middle East and incredibly resilient domestic economic data and corporate earnings forecasts.
The tape is screaming 2 different stories.
We have technical moving averages screaming sell and institutional megabanks modeling targets that scream buy.
It's historically unprecedented.
For you, the listener navigating this environment, the ultimate takeaway is this. Capital preservation is paramount in the short term. You have to respect the technical damage on the charts, monitor that 10-year yield closely, and understand the insidious risks of stagflation.
But don't act on pure emotion.
Exactly. You must also remember the historical precedent. Panicking out of a well-structured, fundamentally sound, diversified portfolio simply because of a geopolitical shock is mathematically rarely the winning move. The institutional desks forecasting 8,000 on the S&P aren't blindly ignoring the war or the Fed investigation. They are coldly betting on the ultimate structural resilience of the global economy over a multi-year horizon.
And as we navigate this profound transition between economic regimes, I want to leave you with a final provocative thought to consider.
Please do.
For the last 30 years, global investors treated geopolitical peace, frictionless globalized trade, and perfectly anchored low inflation as the permanent, unquestionable foundation of their portfolios. Those specific factors define what a safe asset was. It's why sovereign bonds were viewed as risk-free.
The ultimate safety.
But if fragmentation, resource hoarding, persistent regional conflicts, and highly politicized central banks are the new normal, does the traditional definition of a safe asset still exist? Or, in this new, structurally unpredictable world, is extreme volatility simply the baseline price of admission we all have to pay, forcing every single one of us to completely redefine what it actually means to be a conservative investor?
That is a brilliant, unsettling, but necessary paradigm shift to ponder. You have to redefine safety when the very foundation of the financial system is shifting beneath your feet. Thank you for joining us on this deep dive. Stay informed, stay ruthlessly rational in the face of panic, and keep your focus firmly on the horizon.